Namaste. Today, we're going to break down the often confusing world of investing right here in India. The whole idea is to give you a super clear roadmap, whether you're taking your very first step or you're already on the journey and just want to check your direction. Let's dive in.
So, ever look at all the options out there? Stocks, mutual funds, PPF, gold, and the list goes on and just feel completely overwhelmed? Yeah, it's a very common feeling, so trust me, you are not alone. The Indian market is buzzing with choices.
But what if we could just cut through all that noise? Now, I know this chart might look a little crazy, but stick with me. In this explainer, we're going to give you a really straightforward way to think about it all, so you'll know exactly where your money can go and what it can do for you. We're going to make this simple.
To do that, we're going to look at your money's journey in 3 distinct paths, and each one is for a different goal and, a different comfort level with risk. First, we have the safe and steady path. Then there's the balanced growth engine. And finally, for the adventurous, the high-reward journey.
Okay, let's kick things off with path number 1, the safe and steady path. This is all about one thing, protecting what you have. It's for anyone whose main goal is to keep their capital safe and earn some stable, predictable returns. Think of this as the solid foundation of your entire financial house. And first up on this path is the good old Public Provident Fund, or PPF. Because it's backed by the government, it is one of the absolute safest options you can find. It is definitely built for the long haul, though, with a 15-year lock-in period that really encourages you to save consistently.
Now here's the number to remember, 7.1%. That's the interest rate for the financial year 2025-26. Pretty good for something so safe, right? But here's the real kicker. It's completely tax-free. That means the money you invest, the interest you earn, and the final amount you get back, none of it is taxed. It's a huge advantage.
Next, we have something I'm sure you're familiar with, the Bank Fixed Deposit, or FD. For a lot of people in India, this is the go-to choice for parking some extra cash safely for a little while. It's simple, it's trusted, and you can get one at pretty much any bank.
And here's something that gives a lot of people peace of mind. Your money in a bank, and that includes your FDs, is actually insured for up to 5 lakh rupees per person per bank. This is done by the DICGC, and it basically acts as a safety net, making it an incredibly secure option up to that limit.
But what if you want something that feels safe like an FD, but is a bit smarter with taxes? Well, say hello to arbitrage funds. They give you similar low-risk returns, usually around 4 to 6%. The big difference? Taxes. FD interest just gets added to your income and is taxed at your highest rate. But the gains from these funds are taxed like stocks, which can work out to be a lot lower, especially if you're in a higher tax bracket. Definitely something to look into.
All right, let's shift gears and move to our second path, the balanced growth engine. This is for those of you who are thinking, okay, I'm willing to take on a little more risk to get better returns. It's all about finding that sweet spot between safety and growth.
Ever wished you could own a slice of that fancy office building downtown or a piece of a bustling shopping mall? Well, that's what REITs, or real estate investment trusts, let you do. You're basically investing in a whole portfolio of properties that generate rental income, and you can buy and sell your shares on the stock market, just like any other stock. We Indians love our gold, right? But storing it safely can be a real headache. That's where gold ETFs come in. They are the modern way to own gold. You get all the benefits of gold, like protection against inflation, without any of the stress about storage or purity. Plus, you can sell them anytime you want. Now, if you're looking for a higher regular income, you could consider lending your money directly to big, top-rated companies through corporate bonds. These can offer some pretty attractive yields, often between 7 and 9%. The trade-off? Well, there's something called credit risk. It's a small risk, but it's there, that the company might have trouble paying you back.
And now we're heading into the fast lane, our third and final path, the high-reward journey. This is where the goal is to build some serious wealth over the long term, and it comes with the understanding that you'll see more ups and downs along the way.
Probably the smartest and most disciplined way to travel this path is through a systematic investment plan, or SIP. It's simple. You invest a fixed amount of money regularly, say every single month. When the market is down, your money buys more units, and when it's up, it buys fewer. This averages out your cost over time and is a fantastic way to handle market volatility. It kind of smooths out the bumps in the road. So, what's the potential prize at the end of this journey? Well, get this. Historically, over the long term, equity mutual funds in India have given average annual returns somewhere in the range of 12 to 18%. That's the incredible power of compounding, and it's how real long-term wealth is built.
But, and this is a big but, the high-reward path has a very, very dangerous detour, and that is futures and options, or F&O trading. Okay, I need you to listen really carefully here. F&O is an area of extreme risk. It involves borrowing or leverage, which means your profits can be huge, but your losses can be even bigger and much faster.
Let me say that again, because it is that important. Futures and options are not for the average person looking to build wealth over time. They're specialized tools meant for professional, full-time traders and big institutions. For most of us, it's one of the quickest ways to lose a lot of money. Please be careful.
Okay, after all that talk about making money, we have to touch on the not-so-fun part, taxes. Because at the end of the day, it's not about what you earn, it's about what you actually get to keep. So let's quickly decode the rules for the financial year 2025-26.
This little table makes it super simple. Just look at equity for a second. If you hold for more than a year, your profit is taxed at 12.5%, but only on the profit above 1.25 lakhs. Now compare that to debt and gold. In the short term, any money you make is just added to your income and taxed at your regular rate. And then look at the bottom, our friend PPF. Zero tax. Period. See how much of a difference this can make?
So, we've seen the three paths, we've looked at the different investment options, and we've talked about taxes. Now, for the most important part, how do you actually put all of this together for yourself? Well, it all boils down to one thing, matching the right investment to your personal goals.
Think of this table as your quick cheat sheet. It lays out all the trade-offs nice and clear. For instance, PPF has excellent tax benefits, but your money is locked in, so liquidity is low. On the other end, equity mutual funds offer that high growth potential, and you can get your money out easily, but you have to be okay with higher risk. And way, way over at the extreme end is F&O, which, as we said, is only for professional traders.
So let's make this super actionable. Here's a simple checklist. Is your goal retirement? Then the long-term, disciplined approach of an NPS or a PPF is perfect. Is your number one priority just keeping your money safe? Then stick to FDs and government securities. And if your goal is to create serious wealth over the long haul, then starting an SIP in a good equity mutual fund is the proven way to go.
So there you have it. We've laid out the map. You have the safe coastal road, the balanced highway, and the high-speed expressway. Each one leads to a different place. The only question left is, for your financial journey, which path will you choose?